Hey everybody, Preston Bryn here with our Trader User Group. This is our weekly roundup for the last week of January 30th, 2015. Well, we've had a really interesting start to the year 2015. All the major indexes, all the major futures, the S&P 500, the Russell, the Dow, Nasdaq futures, all of them are in the red. So, you know, there's an old saying that if you start off a little bit weak in January, then it doesn't portend a very good year. Let's start off with the Emini S&P 500 Emini futures here. I've got this on the screen here, and as you can see, I've got a couple of things going on the chart. So let me just show you this. Then we're going to step out and look at the cash index, SPX. We're going to look at the weekly here in a minute. But let me just show you where we are here. As you can see, we're clearly in a series of lower highs. It shows up on the screen very, very nicely here. Starting with that high point here at the end of December 2014, we haven't really been able to come back. In fact, we never did even come back and come up to that high right there, because then we had a little bit of a resistance here, and then we're just moving down. And, you know, our low for the year is this red line right here at 1970.25. That was the low, intraday low for 2015. Our intraday high for the year is this line right here, 2067.25. Our opening price for the year was 2055. This is where we sit right now. In fact, our intraday high here of 2067.25 was on the first trading day of January. So from our opening price to where we are right now, the S&P 500 E-mini futures are down about 3.1% for the year. Okay, so we're just not getting off to a very good start here as we go into the year. Now, as you can see from the screen here, we're kind of traversing this track right now, a series of lower highs, lower lows. This is going to be the key right here. These two numbers right here are going to be the key going into the early part of the week, 1970, 1961. Should we take these out, we got a little bit of an interim spot right here, 1930 to 1940, that can serve as a little resistance, but then after that, we're going to come down to a low that you can't see. It's off the screen. I'll adjust it in a minute, which was made back in October of last year. And that's kind of like our line in the sand, so to speak. Is if I just come back in and show you this, you can see right here, down here at 1813. Now, we're working our way down there, folks. We had a very bad GDP number that came out. If I come into a 15-minute chart here and just kind of show you the intraday trade on when the GDP number came out on Friday, you can see right here at this point, right here at the peak, this was right before the GDP number came out. It came out on that bar, and then we just went from there all the way down. It sold off. GDP came in around 2.6 or something like that. They were expecting 2.8, 2.9 or higher. Now this is the first pass of Q4, first pass estimate. Then we got another one in February and another one in March. So it's going to be revised. But the initial pass, the markets clearly didn't like what it saw. So we just had that big sell-off. There was another interesting market that many of our members, and I got some of our members in, or at least I told everybody this is what I was doing. We'll talk about that in a minute. It was in the energy market. But you can see just kind of where the E-minis just fell off as soon as the GDP numbers came out. And then we just never really looked back. So these are the key numbers that we're looking for here. Now, if we look at the SPX, and I pointed this out to our members many months ago, and I said this can, you know, set us up for some pullback as we go into the year. This is a weekly chart, and if we, well, let's just get it back on the screen here. As you can see on this weekly chart, these are our favorite trades, folks, and you can see as we're constantly moving up here, you can see the trajectory here on this weekly. We broke it here, but then we quickly regained it, and I started tracking this in the summer of 2013, right there. And yeah, I probably could have gone all the way back like that you know, and then just extended those lines. And we probably, just for the minor part here, I could probably go back even further. But just for simplicity's sake, you know, I'm looking at it right here. But you can see right now we're just now breaking it. But the key thing I want to show everybody is for over a year and a half now, we've been making this bearish divergence. So each new high, we're running on less and less fumes, which means that we're going to get this pullback. Now, this is the area that I showed, the shaded area that can take us all the way down. Now, this is the cash index down to 1820, right down at the bottom down there. This was the October, right there, October 2014 low. Should we break that, we're going to go down a lot further, folks, all right? But this is just kind of how this thing's set up. We had this bearish divergence. I pointed it out to our members, and I said we got to be ready for a really bad start to this year, or a possibly bad start to the year. The other thing I wanted to show here, you can also see this same divergence in the RSI. You know, when I just condense the chart here a little bit, you can see the RSI. As we move forward in time, we're making higher highs, right? But you can see that RSI is just gradually sloping off. And then from that point right there to this point right here, right in that point right there to right there, we just fell off the table. So again, these bearish divergence signals are the best signals you can find on any chart. They work out. What they don't tell you is how far the pullback's going to be and how long it's going to last. But they do tell you there's going to be weakness in the price action, and you should anticipate some level of pullback. Because we haven't had more than a 6 or 7, or we had a 10% pullback, but I suspect this could be a little bit different. If we come back into the daily chart, again, we're staying with the cash index. You can see right here the 200 EMA, which is just situated just below this low that we made in the middle of the December. I think if we blow this number through, then we're going to come down and test that, which is right around the 200 EMA. Going back to the futures, you can see the same thing on here. The middle December number right there sitting at 1961, all right? And then the 200 EMA kind of sandwiched between 1961 and 1970. That red line, of course, is the intraday low for 2015 for the E-minis, and this is kind of where we're working our way through right now. I do believe we're probably, in likelihood, we're going to hit that number. If we look at the Dow, again, same thing. It's really amazing. All the indices are underwater for the year. Yellow, the blue line was the opening price of the Dow, 17,781. We finished Friday for the Dow at 17,107. So that gives us a 3.8% down move year to date for January 2015 as we close out January. So we're down 3.8% in the Dow, down 3.1% in the E-minis. You can see the intraday low for the Dow. We made the intraday low for the E-minis weeks ago, but we just made that on Thursday with the Dow. And you can see that intraday low here is at 17,062. I think we'll take that out. We're sitting just above the 200 EMA and then the mid-December low, which I think we're probably going to challenge here very quickly. But watch the beginning of the week as we kick things off. The Russell, bad day on Friday, down 27.10 points. Year to date, the Russell is down about 3.4%. So not as bad as the Dow, but a little bit worse than the E-minis. You can see right here the blue is the opening price of the RUT. The red line is the intraday low for 2015. The other red line, the intraday high for 2015, and the all-time high is the green, 12/20/20. So we're sitting just above the 200 EMA. By the way, all the indexes are below their 50 EMA. So I believe we're going to come down and test this as well. More downside can be expected. We may have a little bit of it. Be careful of these dead cat bounces with these big moves down. Like I said, the red is down 3.4%, E-minis down 3.1%, and the Dow is down 3.8% for the year. And then, of course, the one that's the best for the year, as doing the best, is Nasdaq. And we had some great earnings with Apple and Amazon. They came out with very strong earnings, and that kind of propped up Nasdaq a little bit better than the other markets. But as we can see here, Nasdaq is below the opening price for 2015 as well. The opening price 42.40.25, and we're sitting right down here now at 41.43. So Nasdaq is down 2.3% for the year, and Nasdaq also took out its 50 EMA. A little bit further ahead of the 200 EMA than the other markets, but we are still down. And you can see the channel, you know, if I were to draw it on here, it is not as steep as the other channel, okay? And I didn't draw it on very straight, but you can see here that it's still pointing in a downward trajectory, okay? So what we're going to watch for on Monday is, you know, are the bulls going to be able to hold this line in the sand, which essentially call it the 200 EMA for all the charts. If the bulls can hold that and we see some stabilization, then I think we'll move a little bit, we'll be in a choppy mode. I don't see anything that's going to push the markets back up to their all-time highs, which means we're going to be in for a series of chop to maybe slightly down until buyers start to step in again. The earnings this for Q4 coming out now are not up to snuff, as they say. They're not as good. The worst performer for January is the banking sector, XLF, because the interest rates are so damn low. So the banking sector is just doing very, very poorly. And interest rates are very low. If we look at bonds, let me get the chart up here for bonds. You can see the bond market has just been on a tear. I mean, just look at this right here with the bond market. This is a daily chart. We actually bonds started its long rally at the beginning of January of 2013, and it has not looked back. We are definitely in an uptrend here. If we come out to weekly, you're going to see here that we're not that far away from the all-time highs in the bonds, which was made back in 2012. I believe the way the market's going, we're going to probably come up and take that number out. Maybe have a little bit of a pullback and a little bit of chop, but that's what it looks like the market's going to do. At some point, the bonds are going to give it all up, and we're going to take it to the downside. But right now, bonds are just very, very strong. And if we look at the 30-year interest rates right here, this is a weekly chart of the 30-year interest rates. We're coming down to the all-time lows. There's the all-time lows right there on the 30-year. And you can see right here, if let's just get it up so you guys can see. All-time low 1.39%. We're sitting at 1.67% right now with interest rates. We're starting to get in an oversold condition. If we come into the daily chart, you'll see just how ugly this thing is. You can see here interest rates have just been cratering. There is a lot of money flowing into bonds. There's a lot of fear out in the markets. We got the issue with Greece. We got the issue with Russia and Ukraine. We got a global deflationary kind of environment going on. Inflation reports came out in Europe talking about below 0% inflation. That would be deflation. Europe's getting ready to put a lot of money out in the economy. The Feds are talking about raising interest rates, but I don't think they're going to do it in 2015. And they say they are, but I don't buy it right yet. So, and the interest rates and the bonds would suggest that nobody buys it either. So let's see how this thing plays itself out. Now, another one that we've been playing a lot of success, the U.S. dollar. Here's the dollar. Look at this. I mean, when interest rates go up, or they talk about them going up, this is what the currency does. It's like a space shuttle up. There's no bearish divergence on this, folks. I mean, not really. Any pullback is just an opportunity to pick up more longs in the U.S. dollar. It is just, that's unbelievable. This is a big move in the U.S. dollar. By the same token, look at the euro. It is coming down to my target right here. My target for the euro was sitting right in this colored bar here, sitting around 1.08. Now, I didn't think it'd get down there that quick, but this is, you know, the target of where we're going. And this is where the euro is sitting right now at 1.12. So now if it blows through this target, we're going to hit parity. And remember, Europe came out, the ECB came out with their stimulus. They said they're going to stimulate over 1.1, 1.2 trillion euro. And they're going to go out to September 2016. But if you guys remember what the Feds did here in the United States, they said, okay, we're doing quantitative easing here. But they never stopped. Every time they tried to stop, they had to start back again 3 or 4 months later. We went to QE1, QE2, then a form of QE3. So the ECB says they're going to go to 2016 September, but yeah, I honestly don't think it's going to work. I think they've got some fundamental structural problems in Europe that are completely different in the United States. And if the Greeks exit the euro, that'll definitely take the euro down below parity with the dollar. So this is kind of where we're sitting here. We're short the euro. The British pound, we're going to get long the pound. Now is not the time, but this is going to be a great trade. The pound is different than the euro. You can see the pound has been, well, it's been pounded. We're in this channel going down, but at some point this is going to be a good play. Not right now. I think we're going to have a long consolidation period before this thing starts to move up, and when it does, it is going to be a 2-year trade. We're just going to be in and out of this thing for years, playing this thing back up. Currencies tend to trend. The British pound is going to give us that. Now, for those of you out there that don't trade the Forex or futures, the British pound, you can trade FXB, or the euro FXE, or the dollar UUP. So there's a way to play with ETFs. The other one that we were short on is the yen. And you can see the yen. Now, when the yen goes up, that means global, there's a flight to quality. And you can see the yen is in this tight range right here. I think the yen is eventually going to give it up and roll back over again, but not right now. But we've been short the yen. Our trigger was right up in here. We actually got short the yen way back over on the other side of this chart. This was a great trade for us. This is a weekly chart. Right up in this area here is when we got short the yen. And then we started taking profits right down in this area here, and then it was just choppy. So we pretty much stayed out of the trade right in this area right here. Right here with these big counter moves, we started. I started winding down my profits from an exit up in or entry up in this area here, and then I also suggested to people to go short right there too, because I said we're going to come down and test this area right there, which we did, and then now we're testing this area here. There is a little bit of a bullish divergence here, so that would suggest some of a counter trend move, but I do believe it's going to roll back over again because they're still stimulating that economy over there in Japan. They got a lot to do, a lot to stimulate, so that's kind of where that one's sitting. Now, the Canadian currency, or the loon, they're getting killed too. Remember, they're like wherever oil goes, they go. Look at this currency. It just, oh my God, it's unbelievably ugly. Look at the oversold nature, 12.8. on the RSI. We're going to get a little bit of a dead cat bounce here just for sake of getting a bounce. It's probably going to test this low right here of 0.76. I mean, that is an ugly, ugly chart. This is a weekly chart, by the way. To get that kind of oversold down here on a weekly chart like that, that's just unheard of. So we're going to get a little bit of a bounce, but you know, if you can day trade the bounce, great. But just remember the longer term trend is still down. You know, because if we back out of this all the way to when this thing started, we haven't been this low ever in the Canadian currency. And I think we're going to test this area here. I think we're going to bounce back up to this downsloping trend line and roll right back over again. Again, because of oil. You can see right now, even on the daily chart, it gave it all up. Just gave it all up. And the Canadian banks, you know, they cut their interest rates, so that's another reason why, you know, when interest rates are cut by the country, then the currency suffers. But they do that on purpose. They want to get exports very cheap. They want to put some liquidity into the markets. That's what they're doing. The only other one, and we followed it, I haven't traded it in a while, is the Australian dollar. Now, the Australian dollar, like Canada, gets very weak when oil gets very weak. It gets because that's their economy. Their exports are minerals and energy. And you can see the Canadian dollar is also very weak. So, folks, we're getting a displacement in the currency market, which basically means to us as traders is opportunity at some point down the road. And this can go even lower, but then we're going to be ready to pick this up to the upside. Metals and gold, well, I got you guys in gold. I got our members in gold. We had a great trade, and then gold kind of took some profit, which is normal, right? You can see this profit-taking mode, which I told everybody there's going to be some profit-taking here. My target for gold, my initial target for gold, is right up in this area here, around the 1340 area. We had that key break right there. We had a little bit of a head and shoulders pattern. And then once we had the break there, the measuring objective puts us up right in that resistance zone up there. We got up to this area here, and I said before in a prior update, probably a little bit of a pullback, and then one of these kind of numbers. Now, should gold do this, that probably won't bode well for the equity markets. But everything is kind of lining up that way right now, okay? So that's kind of how I'm seeing things. Doesn't mean that's what's going to happen, but that's what the charts are saying right now. Silver, same thing. We got a lot of members playing silver. We got a nice way to play silver long term. Silver came back down below this long downsloping trend line. So it's a little bit weaker, but I think longer term, I don't have a problem with silver. Oil, well, oil took off on Friday. Not like gasoline, which I'll show you. This is a daily chart of oil right here. If we come into the 15-minute chart, you'll see just how crazy this thing went. Here it is right here. You can see oil right here, right in the afternoon, right at this point right here. It was up for the day, but not very much, right in that area there. And then all of a sudden, it just shot way, way up. In literally 15 or 20 minutes, it added over $2 a barrel in less than 20 minutes. It was boom. It was up here very quick because they came out with a report that said the rig count, meaning how many new derricks and rigs are they shutting down in the U.S., it went up to the most in the past 5 years. So that would suggest the supply is going to start dwindling a little bit, which will kind of stop this downward movement in oil and produce some consolidation, maybe some upward movement in the oil markets. Now, I'm playing oil with some strangles, and that worked out well for my strangle with oil. So, but if we come back into the daily chart, you're going to see all it really did, we're still in a down mode. All it really did was move us into this consolidation zone right here. This would suggest a little bit of a contract rally up and then a roll back over again. Now, where we took some longs was in gasoline. Remember, look at oil for a second here. There's really, I want to show you, there's a little bit of a divergence here. If you look at the oil chart, again, this is a daily chart, we're kind of like this right here. You can clearly see there's really not a movement in that direction. We're still kind of consolidating to still in a downward bias, right? So that's oil. But if we look at gasoline futures, it gives us a different picture. Gasoline futures, we're actually moving in this direction, all right? And notice gasoline futures closed here, right below that support point, right in that area there. If we take that out, which is 154, away we go. We're going to challenge this area right up here. And you can see for the first time since back in September of last year, we actually cleared the 50 midpoint level in the RSI. Now, we started getting long gasoline futures right here. I was telling people in and out, let's go long gasoline futures. Or for our members, I also say UGA is the ETF to play. A couple of reasons why. One, we're starting to get into the seasonality where gas tends to move up as we move into the late winter, early springtime. And natural gas, which I am short, tends to roll off and go down. So we're playing some seasonality here. But it's turned out to be a nice trade for those that have taken it. Now, and because the gas also moved very quickly on that report as well, if we come into the 15-minute chart, both gasoline and oil moved. Now look at what gasoline did. It just took off. I mean, you had to have been in the trade, but it was right here, and then bam, it took off to the moon. Now pull back just a little bit, but it's right here. Now we may have a little bit of a pullback, a settle, and then boom, away we go again. So gasoline is a good spot to be in right now, longer term. I think it's going to work its way up. There is going to be a limit. You know, you're going to see the gas rise a little bit at the pumps, maybe 5, 10, 15%, but I think you're going to see it kind of level off. There's a limit to just how far this market is going to move to the upside. Okay, there's going to be a limit to that. So that's kind of where I'm seeing gasoline right now. There are a number of other things that we're looking at in the market right now, a number of really interesting plays. If you're not a member, I'd highly encourage you to come in and check us out. Also, you're getting emails now, or you should be seeing an email, or check out our website. We've got a brand new webinar coming up. It looks like it's going to start next Thursday. I may put it up to the following Thursday, but we've got a number of people that have already signed up for it. If you're a member, it's free. If you're a non-member, it's $199. It's going to probably go over 10 to 15 hours, 5 or 6, 7 different sessions on option trade adjustments, and it's a very key one. I think you guys are going to really love this. Goes into a lot of detail, so I think you guys will enjoy this webinar. So check that out. Otherwise, you guys have a great weekend. Enjoy the Super Bowl tomorrow. Members, I'll see you guys tomorrow night. I'll keep our sessions short because I want to watch the Super Bowl. All right, everybody, have a good one. Ciao.